So Cathie Wood was recently asked what she thinks the single biggest threat is to the stock market today. What's that one thought which keeps her up at night? So in this video, we're going to hear from Cathie about this and her thoughts on some other important topics too. Hi and welcome back. My name is Tom Heavey. I hope you're doing well. I'm not going to make you wait, so instead let's just jump straight into this first clip.
The last question is, what kind of keeps you up at night? What are some of the biggest potential risks out there to the stock market, say over the next year?
Let's see. Well, I have been talking about taxes, and that does I'm quite frankly I've been surprised at how resilient the market has been, given the aggressive policy measures, really, which are capital unfriendly for the most part. They may solve some problems, but they create a lot of others. So, but so I'm left to conclude that maybe some of the things we are talking about all the time are so powerful in terms of their ramifications for the future, in terms of keeping inflation and interest rates down, that this isn't going to be as big of a problem. I always assume, well, there is no free lunch. I think that was a phrase born during what was called back then the guns and butter days of the 1960s, when we were spending aggressively on social programs and on defense. And we ended up paying for that in the 70s with a huge inflation and rising taxes, and really a really difficult period for the equity markets. Maybe this time, because we are so far along in some of these innovation tracks, we're going to avoid that. And in fact, I do worry more about the deflationary ramifications of the companies associated with the companies who have been catering to short-term shareholders. I think it's going to be very confusing. We're going to see good deflation. We're going to see bad deflation. We're going to see companies booming. We're going to see companies sunsetting at best, if not, getting destroyed and going bankrupt at worst. I think it is going to feel a lot like the early 1900s, which apparently went through a lot of social trauma, uncertainty associated with all of the innovations that were evolving at the same time. So I'm very optimistic about the impact of our 5 platforms, 14 technologies, and I think it's really important that investors and people who are looking for jobs get on the right side of change, with the right kind of education, with good domain expertise in some of the ways the world is going to work. And I worry about those on the other side, and it could cause political problems, because this is a lot of people. We think more than 50% of the S&P 500 is going to be hit in some way, shape, or form by the disruptive innovation associated with these strategies. So there will be policy responses, and that is perhaps where the danger lurks.
So obviously, as the most famous investor in innovation, Cathie Wood believes technology is ready to disrupt certain industries. In particular, there are 5 platforms of innovation that she's focused on: artificial intelligence, blockchain, energy storage, robotics, and DNA sequencing. And as Cathie often highlights, as these technologies become more prevalent throughout our lives, the costs associated with them will drop. Now, we know that rising prices is called inflation. Well, falling prices is called deflation. So Cathie Wood believes that deflation is coming in many sectors. She thinks that new technology will force prices down. And she also believes a second deflationary force is coming. That is because companies who haven't been innovating quickly enough will have to cut their prices to remain competitive. For example, Cathie believes that banks will be disrupted by digital wallets. Energy companies will be disrupted due to advances in renewable energy production and storage. So to remain competitive with falling costs, the traditional players in banking and energy will have to cut their prices, and that leads to more deflation. However, cutting their costs will be more like a band-aid, a temporary fix if you will, because many of these companies have outdated business models and simply can't adjust fast enough to upcoming innovation. As a result, many of them may cut costs in the short term, but they will fail on a long enough time horizon. As a result, Cathie's greatest fear surrounds how this will play out. She believes that around 40 to 50% of the S&P could be disrupted in the coming years. Things may get ugly for investors who are on the wrong side of change, and that can lead to social difficulties and political fallout, as is often the case in times of major change. Now, for me personally, I find Cathie's arguments compelling. That's why I'm invested in ARK. At the same time though, I am not selling all of my S&P 500 holdings just because Cathie Wood says so. Time and again, history has shown that the best investing strategy is simple: diversification. The easiest way to lose money as an investor is often to get sucked into the game of trying to pick the winners. Diversification means hedging your bets and holding both so you're covered, whatever the outcome. Now, at the same time, you may feel more strongly towards one than the other, whether that's ARK or the S&P, and so you can raise the percentages that you invest into one more than the other. The point is that just trying to pick one and leaving the other out entirely is probably not a good idea in the long run. With that said, Cathie mentioned in her answer that she'd previously touched on taxes as one of the biggest threats to the stock market. So let's wind the interview back a bit and let's hear her thoughts on this.
What does the amount of government spending and kind of the tax hike mean for the total addressable markets for some of these innovative companies?
Well, innovation solves problems, and taxes are going to become a much bigger cost. So if corporations are finding in this deflationary world that we're describing, at least the technology side of it, that they have a major cost going up, they're going to have to try and increase productivity and in other ways lower costs, or just become more creative with new products and services and so forth. We saw from the coronavirus that innovation actually accelerated in traction because it does solve problems. So, just philosophically, I think a better route to go, I know the policymakers aren't going to listen to me, but better route to go is to actually grow our way out of problems. So instead of raising taxes, actually encouraging more innovation, I think would be the right way to go. If we can grow this economy 1 percentage point faster per year on average for the next 10 years, we'd be out of our deficit. Now that's a lot. That 1% is a lot, but we think it's possible given the 5 platforms that are evolving, the 14 technologies involved in them. They're all growing exponentially. And, I think the taught us that, okay, if there's something that's business unfriendly or creates uncertainty and doubt, innovation actually has a better shot of taking place than otherwise would be the case. The question is, that's the innovation that has been in the pipeline since the tech and telecom bust. All the seeds for what is happening now were planted back then. If capital gains tax rates are going up, and we don't know exactly what's going to happen here, and corporate taxes in large measure, are we going to prevent the birth of some other companies that will provide solutions to future problems? That's, I think, where the risk would be.
So with higher taxes, especially corporate taxes, businesses will be making less money in their bottom line. So in order to keep up their profits, they will have no choice but to innovate. And the smartest companies will bring forward the adoption of these 5 technology platforms that Cathie focuses on. So, in theory, that should be good for ARK. Having said that, Cathie notes how raising taxes could inhibit the birth of new companies and new technologies going forwards. This could bring about negative consequences, but then again, that is more likely to impact future technologies not the 5 she's focused on. As she says, the seeds of those were already planted many years ago. Now, in my opinion, this kind of makes sense. When a technology begins to fall into the sweet spot, where its costs have now fallen to a level low enough for mass adoption, raising taxes is not likely to have much of an impact. At this point, the force of innovation is way too powerful. However, in the years before the sweet spot for costs, if there are fewer businesses able to launch or continue running due to higher taxes, then it means the technology is produced less frequently. As per Wright's law, which Cathie centers her research around, that would mean that costs don't fall as quickly, and so the sweet spot for prices takes longer to reach. So for me, it depends where exactly the individual technology is in its life cycle. If you look at blockchain technology, for example, it's really only in its infancy. We're talking about an industry which is going to radically change the world, and as of today, the world's largest institutions are only just beginning to get comfortable with Bitcoin. Most aren't even sold on Ethereum yet, let alone DeFi or the other numerous uses. A quick point on that. I've talked about cryptocurrency in my last video and my thoughts on where the market is today, so I won't go over it again in too much detail, but feel free to check out that in the previous video if you like. All I will say is that cryptocurrency has historically gone through these cycles. Now, I'm not in the game of trying to predict when the current cycle will come to an end, but things have definitely been getting pretty ridiculous over the past couple of months. So, like I said in that video, I will never sell all of my crypto holdings because I worked in the industry full time for 4 years and I saw firsthand it is the most innovative industry in the entire world. However, I did explain that I trimmed my holdings down to 20% of my overall portfolio. And for those who are interested, the remaining 80% is invested in ARK, Scottish Mortgage Investment Trust as part of my UK ISA. They're kind of like the UK version of ARK, and a large mix of passive market indices to have a well-diversified set of investments across the whole world's stock markets. Now, with all of that said, let's hear more of Cathie's thoughts on something that's so important: inflation and interest rates.
For those of you who have been watching, whether on Twitter or YouTube, what we're saying about inflation, we really believe that once the base effect has finished, and so that will be May, June of this year, that we should be seeing the peak in inflation rates. We think that they're going to settle down, and perhaps settle down to surprisingly low levels, primarily because of deflation. And here we mean good deflation and bad deflation. Good deflation is associated with innovation, the cost curves that are declining in the battery space, in the robotics space, and all of the other spaces that we center our research around. The price declines and cost declines we think are going to be quite significant, and they will start to move the needle in the broader economy as these platforms, DNA sequencing, robotics, energy storage, artificial intelligence, and blockchain technology, as they evolve and start to scale more dramatically in here, the deflationary impulses coming from these technologies is going to start having a bigger impact on the inflation indicators. Now, it should happen sooner, except we have big mismeasurement problems in the inflation and GDP statistics, real GDP and inflation. And that's because GDP statistics evolved during the industrial age, and they are still biased by the industrial age. We're in the digital age now, but we're being measured by criteria from the industrial age. So we think the needle moving should already be starting, but it does take time for statistics to catch up to the realities of how the world has changed.
So Cathie believes that inflation rates should rise until they peak around May/June. After that, the deflationary forces we've already discussed will push down prices, and as a result, interest rates may not need to be raised as high as many investors think. and that's bullish for the market long term. So some really interesting points in this most recent update from Cathie. But what do you think? Do you think as much as 50% of the traditional S&P is ripe for disruption? Let me know your thoughts in the comments below. Thank you for watching. I will see you again very soon.